Hello, YouTube. Today we're going to be talking about how this has been the worst year since 2008. And with a big fat red bar, we want to know what we need to look for going into 2023. Some specific predictions for the S&P and the NASDAQ because, oh my goodness, there are some big levels to pay attention to. And as we can note, stocks have fallen to end Wall Street's worst year since 2008. S&P finishes 2022 down nearly 20%, a $3.9 trillion wipeout on big tech. We also have the worst year since 2011, 2000, 2008, or the worst on record for these NASDAQ 100 megaweights. We also note that Elon Musk is making history. He's the first person to ever lose $200 billion. Wow. So if you had a bad year, just keep in mind Elon Musk has probably lost a whole bunch more than you. What this really comes down to is whether or not we're repeating the 2008 analogy with 2022, or where we only go straight down from here, or if we're going to push this recession to a little bit later and ultimately have the seasonality come back and kick into play here, which means potentially going sideways for the first 3 months of the year. We talked about this last weekend too, but that's largely going to be due to the GDP outlook for Q4, which is still positive. And this is a article here from Fundstrat, one of the Wall Street's biggest bulls, and he's talking about how bottom forms when sentiment is this negative, looking back to looking here to the 1990s, looking here to 2000, 2008, and 2022. We're now actually at a lower level for the AAII report than we have been before. So with a lot to go through this weekend, I'm going to ask you for a favor, please, and thank you. If you could smash that thumbs up, it would be greatly appreciated. All right, let's dive in a little bit deeper. Then we're going to look at some charts. So what this really comes down to is what we talked about last weekend, where we're either going to have a big water slide where we're going to start just dramatically falling lower, or maybe we're going to actually have the start of an up year. And going back here to my Twitter post, again, look in the description if you want to find out more about that. This pattern has only happened 5 times in 150 years. It has required at least a back test of the third candle top, which for us would be 3250. We haven't done it. The saying is that history does not repeat itself, but it often rhymes. And so far, this thing really rhymes. So we know that if we start the year off green, 3 out of 4 times, or 75% of the time, we actually have a green bar that follows. So unless we're going to have a 2008 type event happening, the odds are that we're going to be going higher. I do want to leave you with one more note, though. If you did well or didn't do well in 2022, you have to do something different. If you're not happy with the results you have, listen to probably one of the smartest men to ever live, Albert Einstein, telling us that insanity is doing the same thing over and over and expecting a different result. And I'm saying that because when we look here to an article from Bloomberg, which was published yesterday, it tells us that U.S. stock options smash records, surpassing 10 billion contracts purchased. Single stock and index options more than double 2019 levels. That is before the lockdown to now. People have purchased twice as many options, and options generally expire worthless. So one more time, let's listen to Albert Einstein. If you keep doing what you've always done, expect to get what you've always gotten. If you're insane, at least now you know you need to do something different. So this weekend, we're going to focus on a very high time frame charts because frankly, it's what we need to pay attention to know where we're going to go. I'm going to ask one more time, please and thank you. If you could smash that thumbs up, I would greatly appreciate it. And if you're interested, we do still have our 14-day free trial on where you can trade with me, Justin from YouTube, to see how we take all these notes to formulate a plan and try to beat the market. All right, let's jump in because there's some stuff for us to go through here. So first of all, we're going to look here at a 12-month chart, and I already have the support and resistance outlined here. Green means support, red means resistance. It's pretty simple. And because we look at the S&P as our guide and the NASDAQ being the biggest component, what we're going to look at here is going to be 3 really important areas. We note that we have some green lines and we have a red line. So all this really means is that when we look here to the green lines, it shows support on a 12-month candle. Forget this is S&P. So just look at it as a candlestick pattern. What we need to look at is going to be the support going back to the 2020 top, the 2021 open and low, and then the low from here. So the odds are that we're going to open up with an inside bar, which means that consolidation is likely going to happen unless we're able to get back above this candle high right here at about 475 and 480 on SPY, or if we crack below our lowest level at 348.11, the odds are that we're forming consolidation. Consolidation to what? Consolidation to go higher, consolidation to go lower, or just an inside bar where we don't really get direction. We have to wait for the next candle, which would be 2024. right? Remember that. That's another year out. So please keep that in mind. But because we're looking at real bodies and wicks, this is what we look for. I would also note that this is a pretty fat red bar. We're closing out negative 19.48%. And we also have a bigger red bar, which means this is pretty bearish. Final thing I'll say here before we move forward is that we whether this is S&P or not, what we generally look for is that the volume confirms the price action. And with the percent decline here of we dropped down by as much as 130 points, and right now we're down by about 100. We go 100 divided by 130 minus 1. It means that sorry, not minus the 1. We're at the 76th percentile of this decline, which means that we've only recouped about 23% of our losses, which means that the bears are pretty much in control. However, the part that is missing for confirmation in a true bearish engulfing pattern, which I've talked about before, is that we have to lose the 2021 low. Otherwise, we did engulf the pattern, but we're not holding the low. So falling back below 264.82 would start to give us more bear confirmation, but it is not confirmed until we actually lose the 348.11 area. There you go. At a very high level, that's the S&P. Looking here to QQQ, well, this one doesn't look good. Looking back in history, same thing here. If we're going to get a back-to-back red year, we're basically repeating a 2000 type decline for the Nasdaq. Or here we're looking at QQQ. Again, I understand we're not looking at NDX, which is the index, or the Nasdaq. Here we're looking at QQQ because that's what I like looking at. So if we're not going to repeat 2000, we need to start advancing. I would also note that the last time this happened, we had a higher high, we had a higher low, and we open up. And then once we lose the low from the previous candle, that's where we get 3 consecutive red years. So keep that in mind. When we look here to where we are right now, we look to the 2021 low levels are right here, 297, 315. We need to start recapturing those areas. Like we have to get above them. These numbers right here correspond with the red lines from the candles. You can also note where the horizontal ray starts from, which indicates the level I'm looking at. So 315 is going to be the 2020 top. 297 is going to be the 2021 low. And the only level of support that we have here before we go all the way back down to 215-ish is this year's low at 254. And if we use that same, again, percentile that we used on S&P, we note that we're down by about 148 points. And right now we're only up by about, we've only recaptured about 11 of them. So we go 137 divided by 148. We're 92. We're in the 92nd percentile of this decline, which means that we've only recaptured about 7.5% of the low. Technically, it's not a bearish engulfing pattern because there's a lower high and a lower low, but we are below the 2021 low, and that is found right here at 297.48. So for technology to be bullish, we have to recapture that level. For technology to be bearish into 2023, all we have to do is drop down by it's not even that much. It's about 5%. Another 5% drop, and that's over. Right? We're back into another bear year. And let's keep in mind what actually happened this year. Looking back to a 1-year performance or a 12-month rolling basis, well, it's pretty red everywhere. The only sectors which have done well have been health technology, energy, health services, a little bit of utilities, a little bit of consumer non-durables, but otherwise it's pretty red. If we go no group, right, it's pretty red everywhere. So there's some pockets of green, but the dominant theme is red. So we have to understand that there is an uphill battle going into next year, but with very clear levels, we should know exactly what we need to look for. We're going to look at 2 more patterns now. Then we're going to go through and look at all the normal weekly charts that we do. And then we're going to leave it there because I want to leave you with a simple message of let's make sure we focus on very high time frame charts because that's what's going to be my guide going into 2023. All right, so now we're going to look at a 1-month chart. And as we look here, what's so important is that we look where the green and red lines actually correspond on a monthly candle. We're not going to look at a quarterly chart. All I want to look at here is going to be a monthly chart. So technically, we are over the 50, and we're trying to form an inverse head and shoulders in here. So if we maintain those areas I just laid out, 378, 364, and we start advancing, that's constructive. Is it enough? We'll find out in hindsight. I'm not sure what's going to happen in the beginning of the year. So I'm just prepared for what if I'm right and what if I'm wrong, right? What if I'm right, but also what if I'm wrong? That's like really important for me. I would also note that we are trending up in the short and long term because we are above the 50 and 200 MA. If you can't draw trend lines like I'm doing or lines in general, Just look at the moving averages. The 50 moving average is considered the short-term price, and the 200 MA is considered the long-term price. So if we're above or below, all it signifies is that if we're above, means we're going up in the short term. If we're above the black line, we're going up in the long term. That's that simple. If we look here to QQQ, this is where things get a little bit more tricky because we snap those lines back in, and whoa, okay, well, exactly where we would expect to find resistance, we did both times. We declined on the monthly chart exactly on those annual levels. So if you're focused on a 15-minute chart, yeah, you're probably not even noticing the bigger picture here. Whoa, we rallied up hard into Friday though, Justin. Oh my goodness. That's it. Bull market intact. Please make sure you recognize the higher time frames here. Also look at the volume. Does it confirm the pattern? Yeah, dominant red. So keep that in mind, please. Last thing to look at here is just the fact that we're closing below 271.23, which is our 50 monthly moving average. We almost got a bearish engulfing. We're closing really close to the low, but pay attention to when we close below this area. The last time this happened, oh my goodness, we have to go all the way back here to, let's actually go to a log scale so it's a little bit easier to see. We have to go all the way back to August of 2008 for the last time that we actually closed below the 50 monthly. That's right. One more time. The last time we got a candle close below the 50 monthly was all the way back here. And if we look a little bit more closely with an objective eye, meaning we're trying to find the truth, not what we want to see, we have to note that we got one, two, right? Basically 3 tests on the 50 monthly, one more time, and then we lost it. What does that mean? Well, it means that people had 1, 2, 3, roughly 4 chances to buy that 50 monthly, which should act as support. But then when buyers get exhausted, sellers start dominating, that's when we plunge lower. There's buyer exhaustion, right? And the sellers are just willing to get out. That same thing happened here too, where the red bars start creeping up over time, which adds what? It adds pressure for us to go lower. So if history is any guide, the 2023 prediction should be fairly simple. We're looking for confirmation on technical levels, but as we're closing, just like on a daily chart or a weekly chart or any chart, when we close close to the low of the candle, the odds, again, not a guarantee, but the odds are that we're going to get continuation lower. Does it have to happen immediately? The answer is no. There could be a delayed effect. Just like we showed you with that seasonal chart where it could take up to 3 months of going nowhere before ultimately we get a decision. And why is that 3-month level so important? Well, we've talked about this on the previous video. I'm going to briefly talk about it now. And the reason why is because if we get a positive GDP number, the market might kick the can down the road where they're like, well, we still have a strong GDP. We're still growing. So no recession here. No point in pricing it in. So remember, this is going to be reported in the first quarter. And then the next time we get a GDP print is going to be for Q1, which will be reported in roughly April. So there you go. That's what we're watching for. It's really simple for me this week. All right, now let's shift gears here and have a look at our weekly charts because actually not a whole lot has changed. We look here to the S&P and we note that we have a dominant red downtrend, which means the dominant pattern right now is down. Our resistance is found here at 389 or 390. We have might have a doji again, which means we're going nowhere. Inside bar. We have support found at 370. Not much else to say beyond that. Volume is dominantly red. So we're watching for these levels to hold as we record those daily videos for you next week. Looking forward here to QQQ. Well, not only are we below the 50 monthly, we're also closing below the 200 weekly here for 1, 2, 3 times in a row. That is 3 candle closes below the 200 weekly. It's looking pretty bleak here, but it does not mean we have to go down immediately. The stage is set now, and all we have to look for is going to be whether or not the red volume is going to turn into red selling continuation. Last thing here, if we look at SPY and QQQ, inside bar here on SPY, which means that we're just consolidating. So we're likely set for an annual consolidation, a monthly consolidation, and a weekly consolidation. On QQQ here, we actually have a failed breakdown again. Last week, we did not get it, but a failed breakdown below the 200 weekly is not really getting me excited to look at these charts. It tells me that the onus is on the bulls to break us bullish. We have a dominant red downtrend, which means the dominant trend is currently down. Looking here to the DXY or the dollar index, we note that we're back testing previous resistance. So what was resistance turned into support. We do have a push off the 50 monthly, which means that it's trying to fight for direction. We have a golden cross, which is bullish. We have an apex here or a crossroads, which means Going into February 6th, the date down here, where we have this uptrend formed, if we're still above it, we're maintaining a bullish uptrend. We're looking for higher highs. If we fall below it, we're looking for lows, maybe back down here to about 100, if not back down to about 97. Watching DXY really close. A couple more charts here. VIX. VIX is going a whole bunch of nowhere. When we look back to previous periods, as we talked about on Friday, there's usually one big spike. There's a couple spikes here. There's the big one big spike, one big spike, one big spike, one big spike, one big spike. Same thing as in 2020. What's different in 2022 is that we have talked about this recession, this bear market, this global downturn for so long that we had how many spikes of volatility? One, two, three, four, five, six. That's six spikes of volatility. But because the market was not caught offside, it had six chances to reprice, to buy insurance, which means that if there's been sufficient planning for people to get insurance, the VIX is probably not going to get elevated. For the market to form an actionable bottom, which is what I've been calling that lately, we generally have to go above 40. That has not happened in 2022. So if we're going to get that green candle, as the yearly chart implies, after a bearish engulfing 3 out of 4 times, we can't see the VIX get elevated. It's below its what is it here? It's below its 200 weekly and its 50 weekly, which means it's trending down in a short and long term. We need to see VIX going higher for us to probably get that big rout, which means a stock market crash. Looking here to the 2-year note, this is telling us that in the last 2 weeks, inflation expectations are rising. And this is a bullish break. It's maintaining its uptrend all the way back down to basically 12 months ago, December 6th, 2021. This is bullish. Bullish for yields or bonds is bearish for stocks. We also note we have the 10-year note here, and it's up more than 10% in the last 2 weeks. There's a few things at play here, including that people are now demanding a higher yield because countries like China are coming back online, and there's just more places to put your money. The US is not the only game in town anymore. We're not using TINA, we're using TARA. TINA means there is no alternative. TARA means there are reasonable alternatives. So whether or not it's going to hold through to 2023, we will find out. All right, a few more quick charts here just to see if anything has actually changed. We'll look at these major ETFs, and actually not a whole lot has changed. Levels are right here, same as last week. Encourage you to go back and watch those if you want. Otherwise, the Dow is outperforming the NASDAQ. It's over the 50 weekly, and levels have stayed the same. Red, white, and green are all the same. The Russell, failed breakdown, throttling the 2018 and roughly 2020 highs. Let's see if it turns into support. I'm not sure. Looking here to RSP or equal weight S&P 500, we note that not a whole lot has changed. Inside bar. All right, so no update here. Looking at the New York Stock Exchange, below the 50, but pretty close to getting above it. We have a higher high and a higher low, which means the 2,000 stocks are actually more bullish than the S&P. Again, it's largely due to the NASDAQ. Looking here at XLV, bounced off the green line. It's looking constructive, much closer to all-time highs than not. Why? People like to stay alive. It's that simple. They're not going to be frugal on trying to stay alive. Looking at XLF, we're actually above last week's high at about 4 cents, and it looks constructive. The 50 monthly roughly corresponds with our red line. Let's see what happens. Pretty small bar, to be honest. It didn't really move all that much. XLK or Tech, still above the 200. As a reminder, XLK and QQQ have different weighting, largely due to Tesla and Amazon, which are more heavily weighted in the Qs, where XLK is more lightly weighted or doesn't hold as much of those stock. So if we're looking at XLK or QQQ, we also get a different story. Looking here at ARK, oh my goodness, it's down to 5-year lows. That's right, 5-year lows. This chart is stinky. Lots of work to do on this one. Looking here at XLU, battling for the 2020 high and right around the 50 MA. That's why it's pink. It's a pivot. Moving forward to XLE or Energy, multi-year highs. It's bullish, has that same uptrend, has the same golden cross, just like we saw on yields. And then that's it. Emerging markets, a little bit red. And then FXI, red on reopening. So thank you so much for tuning in. I look forward to seeing you next weekend. And if you want to join me in our group, again, you can find that at thealgo.com. If not, I thank you so much for watching. And if you wouldn't mind smashing that thumbs up as we're signing off, I am going to thank you ahead of time. I wish you a fantastic new year, and I look forward to seeing you in 2023. Thank you so much.